My name is David Jaffe. Welcome to the Wealth and Health Podcast, where you'll learn valuable skills and positive habits that will improve your life. This podcast originally aired as a video on my YouTube channel at youtube.com/beststockstrategy. The Wealth and Health Podcast is brought to you by beststockstrategy.com. Why selling options and collecting option premium is a trap. So this title is a little bit clickbait because selling options should be one component of a profitable trading and investing strategy. However, in the past, I used to primarily focus upon selling options and collecting premium. And when conditions are right, you can make a lot of money by doing that. I think it was around 2017 where I made around 75% just by selling option premium. And one of the reasons for that was 2017 was one of the least volatile years on record. So during accommodating markets, when there aren't that many gyrations and the market doesn't go up and down tremendously, you can be very aggressive. You can sell a lot of contracts with strike prices that are relatively close to the current market price, and you can collect a lot of premium. The problem is during periods of low volatility, which means that when VIX is trading below 15, if the market then has a sudden collapse or even a mini collapse, like what happened in early August 2024, you can see VIX increase by 200 to 300% in one day. And during those times, if you sell too many put options, then you're going to be showing major losses and you're probably going to be placed into a margin call. That's why if your primary strategy is to sell options and only collect option premium, I believe that long-term you are not going to be profitable. Now, there are many different iterations that you can use in order to be profitable. For example, you can sell put options in order to take assignment and then you can run the wheel strategy. Now, the risk on this strategy is sizing and correlation risk, because if you're assigned shares, then the buying power requirements on owning shares is about 2.5 times more than the buying power requirements for selling options. As long as you're selling options on great companies that you actually want to own and you have the amount of capital to take ownership of these companies, then running the wheel is a great strategy. What I like to do is buy call debit spreads on amazing underlyings with strong brands, market-leading stocks, or indices that have a tendency to go up. And then to finance the call debit spread, I will then sell options to finance the call debit spread so that way I can participate in the upside of the stock. Now, this strategy is also very flexible. I can use it as a hedge as well. I can buy a put debit spread and use that as a hedge and finance it by selling call options, whether they be naked calls or call spreads. So there are multiple permutations that you can use this strategy to capture directional gains. And I think that's one of the beauties of this trading strategy, because when you're only focused on selling options, your maximum profit is going to be the amount of credit that you receive. However, when you take directional plays and you purchase call debit spreads or put debit spreads, and then you finance it by selling a put spread or a call spread or some type of combination of both, you can then profit from large directional moves. And integrating this strategy with my other trading strategies, such as 1DTE trading and proactive hedges, has worked wonders for my returns. It's really allowed me to juice my returns while also decreasing the volatility of my overall portfolio. If you have any questions, leave a comment below. Please subscribe to this channel. If you like this video, then you'll love this video, so click on it right now. Visit beststockstrategy.com and submit your email address to receive invaluable free training. Please give this podcast a positive rating and a review. If you have any questions, visit beststockstrategy.com and send me a message.